let's talk a little bit first about where we think the state of the world and the state of the economies are at the moment.
Okay, yeah, perfect. Well, right now it's all about tariffs. It's obviously all about Trump tariffs. That's what markets are responding to. So obviously, you know, they initiated in sort of, I think, start of March, in February with Mexico and Canada, and then April to rest of the world. And markets did not respond positively. That is, share markets did not respond positively, and they sold off fairly rapidly. And then as Trump unwound tariffs, the markets responded positively. They've come back on higher for China, and so markets have been incredibly volatile. And that's beyond share markets. It's also bond markets. So this volatility, we believe, whilst it's been going for a couple of months now, it's likely to continue for some time yet. Why? Because the winding up of tariffs, the winding down of tariffs, we don't know what's next. No one knows what's next.
No.
Companies are responding with, I guess, along the lines of that uncertainty. So they're not taking action. So there's a lot of downside risks on the economy. That is, US economy and global economy. Now, what I should add is that there is the current economic data looks good. Like unemployment's low in Australia, USA. Economic growth looks good in the USA. Australia's fine.
Well, isn't it?
Yeah, Australia, in terms of the economic data, is fine. USA data looks fine, but that's all in the past. So the outlook economic data for the USA is starting to look a bit grim.
Sorry, Aaron just had a baby, for those who know Aaron. Well, he just put his baby around the corner. And sorry, I had to interrupt. The baby just came around the corner and I was smart. Look, there's the baby
I think
again.
we're in for an end.
He's doing it again. Okay, sorry, that was very important. Okay, sorry, Michael, back to very important things about tariffs. They are important, I agree. And I do know that the Australian economy is doing quite well. We're up to the American economy. And
yes, so the outlook is that basically the global economy and the US economy specifically is looking like the growth is going to reduce significantly, and so that'll also feed into more market volatility, which is our expectation and really how we've sort of, positioned everything as well.
We were sort of positioning for that before Trump was elected.
Correct.
Really. Yes.
Correct.
Yeah.
So into the positioning of our portfolios, I guess our portfolios have, there's three main, drivers of our returns. Okay.
Yeah.
First and foremost, we design the portfolios with the long term in view.
Of course.
Okay. And so the main driver will be asset allocation. We do expect long-term share market to outperform bond market, to outperform cash.
As it always has done.
As it generally has. And so that's how it's positioned primarily. Then we have two other major biases in the portfolios. Today, because we've already been positioned this way, we have agreed that we're not changing the portfolios. Everything's where we expect them to be and want them to be. Our two biases are amongst the share market. We have a bias towards cheaper markets.
Yes.
Cheaper markets include Australia versus USA, emerging markets versus USA, even small companies globally versus the rest of the world or USA. So they are much, much cheaper, and that is our bias. And in recent times, that has worked where what we call value securities have outperformed the market. Okay.
And part of the reasoning for positioning in these sectors would be a little bit to do with the tariffs coming onto places like China, who are then looking for other companies, other countries, to export some of their manufacturing to, or is that?
No, well, yes and no. So there is a bias towards China with, say, for example, emerging markets being in our portfolio. But it's probably more to do with respect to the pricing of companies like the Magnificent Seven, where they've really been priced for perfection, and perfection includes perfect economic growth. Well, what we're seeing in terms of the outlook for economic growth is weakness. And so when economies, start to look a bit weaker, what gets punished the most are those companies that normally price for perfection. So think of Magnificent Seven like those, the big tech stocks, the AI sort of bias. So we've sort of been a bit underweight those. We certainly hold them,
Yes,
but we're
yeah.
underweight.
Yes.
And so
unless
that's
you're
the
in
main
jet
reason.
fuel.
In
Unless
jet
you're in
fuel.
jet fuel.
Well, we've had some really good exposures in jet fuel as well, which has sort of cushioned some of those tech
Yes,
stocks. Like we've
yeah.
had gold and agriculture and infrastructure, which have all done really, really well. So we've got a fairly balanced thematic there with jet fuel. But I will just quickly talk about our third bias, which is on the defensive, and this is critical. We have very much a bias towards quality securities. We've got cash, enhanced cash, which is really investment grade, and we've got global bonds, Australian bonds, and it's all very strong investment grade stuff. We've seen punished in the last couple of months has been higher yield junk bonds.
Okay.
We're absolutely underweight junk bonds in a significant way, but that is the one market we're keeping an eye on. That is one market where we think opportunities will arise.
Okay. What I like about the way we've positioned our portfolios is that we've got 5 very strong managed accounts that range from very defensive through to high growth.
Yep.
And each of these portfolios has been positioned months ago now to be more value orientated. That would be
Yep, that's 100%
statement.
correct. Yes.
So what we've also managed to do is we have a fund called Jet Fuel, which is my favourite.
High growth plus.
High growth plus. And look, it does extremely well, and in times like now, not so well, although like you said, with the cushioning of gold and agriculture and some other thematics in there,
That's right.
which Michael actually is the driver of, because I would have it predominantly in everything gearing AI, but again, that's long term. And I think if you had, let's just take $3 million as a figure, for me, even as aggressive as I am as an investor, I would still want to have a good 80% of that money now across in a probably a high growth managed account that was value orientated, that was strategically positioned to see through this volatility, which is going to happen with the markets being jumpy, with Trump doing one thing and the week, 1 week later doing something different. It makes it sort of a time, I think, when a lot of countries even are sitting on their hands
100%.
and just waiting to see what plays out.
In fact, that's sort of one of the drivers to weaker economic growth. Because of uncertainty, companies are afraid to take action. Are they going to hire? No, because they don't know what's about to happen.
Yeah,
That's
and
right.
anything can change from almost one day to the next.
Yeah, correct.
So I would, even though I'm aggressive, I would like to have a large portion of my funds invested in something that I knew was being fairly well looked after and fairly defensive, albeit with some potential to still grow and at least beat the index just even marginally. And then for me, something like jet fuel allows me to look at something that might play out over a decade, like AI, because I still am a big believer in AI. I still think AI, and in the longer run, I'm talking playing out over the next decade, there are definitely areas, thematics.
And thematics is really how that particular portfolio is structured.
It is,
So we have a number of thematics. So ESG, obviously one.
Yes,
like we know there's an environmental movement that is ongoing, a social movement, etc. So our agriculture is sort of part of that, but we've also we've got a few other strategies in there that's sort of capturing that ESG theme.
And the longer term theme. On that, you've just come back from London.
Yep.
Europe's, in my knowledge of Europe, has always been well known as the ESG forward thinking.
True.
So any sort of tips for us coming back from London?
Right, yeah, on the spot there. Look, believe it or not, this sounds like I'm name dropping, which is the last thing I ever want to do. I was very lucky, myself and the 10 people, researchers that I was there with, and I've told you this, we had an afternoon with the Lord Mayor of London. Okay.
Very nice.
And we're in Mansion House, which is pretty phenomenal.
Very
but the Lord Mayor of London is not who you see on TV, the Mayor of London. The Lord Mayor of London is similar to here, is elected by aldermen, elected aldermen. And he looks after like a 1 square mile in the centre of London. But his primary responsibility is to attract business to London, and primarily financial services. And he spoke of visiting Canada and spending a lot of time with Canada, and he's also been travelling other parts of the world. And what he's seeing is, I guess his message is, don't do business in New York, where there's a lot of turmoil at the moment, I guess around USA and the actions there. He's saying, London is a financial hub, second biggest in the world after New York. come and do business there. And he's sensing, some potential take up and potential more business for London. So, which is a change that maybe a few months ago many people wouldn't expect, but I think we probably should see more of.
Yeah.
We're likely to see more of, where a switch away from USA.
Yes.
And our portfolios, to jump there, are certainly underweight USA at the moment. We're not out of USA, we would never do that, but we're certainly underweight.
For now.
Yeah,
but
that's
we're in the position where every month, and it's certainly every quarter, we're able to adjust these portfolios.
Correct.
If we feel that there's reason to do so.
Yeah, that is correct. So if there is an opportunity in the market, like intra-quarter as well, we'll convene a fairly quick investment committee and we'll vote on that.
That's the benefit of the managed accounts.
Correct.
Within 1 hour of you leaving here, we can have things changed and turned around, and 24 hours later,
Correct.
the accounts have all been changed.
That's right.
So,
and every investor is treated equally.
Exactly, which I love.
Yep.
So anyway, thank you very much. Thank you, Michael. See you again next month.
Sounds good.
And thank you.